So I know that you know this, but the paradigms associated with commercial real estate have changed dramatically over the last 12 months. Transaction volumes are down as much as 90%, and values are falling precipitously. Welcome to the brave new world. Today, what we're going to talk about is how to pivot and prosper in the brave new world that we're facing. And the game has changed. I'll walk you through exactly what I'm talking about. Let me share my screen so we can get going. So, pivot and profit. Real estate paradigms changed, shifting dynamics. It's literally a brave new world in so many ways. What you do over the next couple of years may very well define the rest of your lives, meaning that we're going to see opportunities in commercial real estate that we haven't seen in a generation. I'm telling you, I've been in the world of commercial real estate banking and investing for more than 30 years. And in that short period of time, I have never seen such dramatic change in values, in investor interest, in banking in terms of their appetite to lend additional dollars. It's dramatic, guys. Most of us are still trying to come to terms with what the hell is going on. And that's one of the things we're going to be talking about today. But most importantly, what we're going to talk about today is how to master the critical keys to executing in today's environment. And when I say execute, whether you're a broker, owner, developer, sponsor, or potential investor, determining how exactly you're going to navigate throughout this strange place is going to be our core theme. So Einstein said it best: in the midst of every great crisis lies great opportunity. I'm 100% sure that's true. Again, I haven't seen this stuff since 1991, when I was a very young vice president with Bank of America. Eventually, I ended up running several divisions, including CEO of the special servicing group there at B of A. But I also ran a subprime business and a commercial mortgage business, which was long-term debt that was, unfortunately, at the time, largely delinquent, much of which we acquired through other bank acquisitions like Security Pacific. I've done more than $11 billion in transactions. Most of them have been either subperforming or non-performing transactions. In other words, sold a lot of notes that were not performing, sold a lot of real estate that were not performing, bought a lot of real estate that was less than performing or non-performing. So I think I know this space fairly well. I've only been doing it for about 32 years, but I'd like to think that there's a grain of logic or reason or education you might find from spending a little bit of time with me. So before we jump into exactly what's going on today, we need to look back over the last 24 months and determine how exactly we got here, because times are bizarre, my friends. Times are very, very strange. I will tell you this. We are seeing, and I don't know if you could, there we go. We saw in early 2020 the most incredulous injection of liquidity in the history of the United States. And what I mean by that is Federal Reserve cranked up the printing presses at a rate that was astronomical. So this line down here is the amount of M1, or the money in circulation, the readily available funds. And as you can see, it was a relatively steady incline. And that's a result, frankly, of just growth of population and growth of number of businesses. You need to increase the money in circulation. 2010, Ben Bernanke cranked up the printing presses, and over a 10-year period, he doubled the amount of money in supply, the money in our aggregate supply, if you will. In 2020, in roughly April, Federal Reserve really cranked up the printing presses to a degree never seen before. As you can see, this is overnight, they injected $12 trillion and another $7 trillion over the course of the next 12 months. So in aggregate, they increased money supply, M1, by 500%. There's no way our economy doesn't crush it after that. When our economy, our GDP, our gross domestic product, our gross output, if you will, is largely based on consumers buying goods and services, then you know our economy is going to explode because you made the consumer rich. You made people rich. You know some of the means by which I'm talking about was PPP and STEM checks. Household wealth exploded overnight to levels we had never seen before. So this experiment has gone awry. They exacerbated that problem with ultra low interest rates. As you could see down here, guys, they reduced interest rates to effectively zero, less than zero after considering inflation. Fed funds rate was down to 0.25%, 0.25%. And when it went down to 0.25%, so did a lot of the leading indices like SOFR, SOFR, which is a primary index for commercial real estate. Subsequent to that, though, as you can see right here, Federal Reserve, in their infinite wisdom, jacked rates at a rate we've never seen again before in the history of the U.S. Now, they did it because they caused, through their injection of liquidity and very, very low interest rates, bubbles in every asset class, whether it's single-family homes, commercial real estate, stock market, which are still at all-time highs and about to tumble to a very huge degree, used cars, price of lumber, you name it, Bitcoin, prices went through the roof because we put so much money into the economy, or the Federal Reserve did, I should say, and they made the cost of debt so low that everybody wanted to borrow as much as they could, which dramatically increased their spending power. The consequences are very real, though, guys. I mean, inflation that we're seeing today is the worst that it's been in more than 40 years. And that's a direct consequence of what the Federal Reserve is doing. So they went from huge quantitative easing, dumping money into the economy, and buying treasuries and buying mortgage-backed securities, lowering the effective interest rates. That is backfired, and it backfired in a very robust way. And they're trying now to use a sledgehammer to crush our economy, to quell the inflation that is raging across the board. So who's affected by this? Well, clearly, you and I, when we go to the grocery store, we're paying ludicrous prices for our groceries. I mean, or even a hamburger. I'm telling you, I took my son out the other day after surfing. We bought a couple of hamburgers. I was shocked that between the burgers and the drinks, we spent $50. $50 for a couple of very mediocre meals. But look, I live in Laguna Beach and it's just expensive to be here. So I get that. But I know all of you feel the pain that I'm talking about. Well, I want to go beyond that, though, because we're talking about real estate. And some of the biggest players in the real estate world are PIMCO, Blackstone, Brookfield, and Starwood. They each have given back billions of dollars worth of real estate to the lenders. They have literally thrown in the chips, tossed the lenders the keys, and said, can't make it work, don't want to make it work, better to use my money and my time elsewhere. These same companies have raised collectively, not just these four, but more than that, more than $300 billion to capitalize on what will be, at least in my opinion, generational opportunities to buy really good real estate at massive discounts. Talk more about that later. So this is a reiteration, but the Fed turned from quantitative easing, making it easier for all of us to buy goods and services, to quantitative tightening. By the way, it was never about a lack of supply. I don't really care what you're talking about. It was overstimulated demand. I remember looking off the coast of Huntington Beach, and this is 2021, and seeing 40 very large cargo ships stacked up almost on top of each other, waiting to unload at the ports of Los Angeles and Long Beach, all the stuff that we were shipping in from China. That stimulus was a problem. And now their quantitative tightening is going to be even more of a problem, guys. It's crushing values across the board, across the board. Some of that value destruction hasn't shown up in areas like the stock market, but I assure you it will. We're predicting by the end of this year, we'll be definitely deep into a recession and a major market correction. That is simply because all that money that the Federal Reserve put into the average American household's pocket is gone. Debt levels are racing to the north. They're going up at levels we haven't seen literally ever. So household wealth went up. It's dropped to lower than it was prior to the COVID pandemic. Debt levels are racing up radically, and default levels are increasing dramatically. It's a scary time, but I also think it's fraught with opportunity. There's still too much money sloshing around in our economy. You can't inject $21 trillion and not expect to see massive consequences. So pay attention, please. I promise what you will learn will serve you. In the next 24 months, more than $2 trillion in transactions will occur. Now, that's as compared to over the last 12, where transaction values or transaction numbers are off 90% in some markets. The vast majority of these transactions of that $2 trillion are going to be distressed assets. Why is that? Because we know that for sure in commercial real estate alone, there's more than $1.5 trillion of loans maturing in the next, call it 24 months. The vast majority of those loans are not refinanceable for a variety of reasons, some of which we'll talk a bit later. Problem is, these transactions are not standard transactions. It's not a willing buyer and a willing seller. The lender is deeply involved because the lender is likely to take a loss when the property sells because values have declined so dramatically and so quickly. That's simply what happens when you increase interest rates exponentially in a very short period of time. The players have changed. The lender is a massive influencer on the outcome. So two types of transactions actually are going to occur over the next 12 to 24 months they're going to be very robust. They're going to be the dominant transactions in the marketplace. That is a DPO, a discounted payoff, and a note sale. And why are these going to be the dominant players? The dominant transactions in this marketplace, I'll share with you. Because regional banks hold a huge portion of the overall debt associated with commercial real estate. They're a huge lender in this space, and regional banks are in trouble. Specifically, over the last 6 months, we've seen 3 of the 4 largest bank failures in U.S. history. Silicon Valley Bank, fundamentally, guys, there was nothing wrong with their assets, but there was a massive outflow of deposits, which caused a huge problem. Signature Bank followed on Silicon Valley, and beyond that, it was First Republic. None of these banks had fundamental problems with their operations. Many of them, unfortunately, had long-term maturities. They took their deposits and put them in long-term maturities, which was a mistake, obviously, because that's ultimately what caused the bank failure. The largest bank in history in the U.S. to fail was Washington Mutual. They were a huge real estate lender, primarily in the subprime mortgage business. They led that business to a very large degree. They failed and ultimately were acquired by what is now the biggest bank in the nation. Bank failures will continue to happen. What we're seeing and have seen thus far is just the tip of the iceberg. We're in this period of what I would call the calm before the storm. And again, I am not pessimistic. I think I am largely pragmatic, but I'm reasonable. I look at history and to determine what's likely to happen next. And what's going to happen is banks will start to fight for their survival. Deposit outflows have hit over $1 trillion over the last 6.5 months. That number is historic. We've never seen anything even close to approaching that. Credit quality of the loans is worsening, and largely commercial real estate loans, but it also includes single family loans, credit card debt, commercial and industrial loans. They all are struggling. You can't increase your monthly interest expense by 300% in some cases and not expect to see some massive consequences. Guys, like, just as a sidebar, I'm a huge believer that we should be asking for Jay Powell's resignation. He put us in this situation, and now he's literally destroying our economy, hell-bent on this ludicrous number of 2% for inflation. Economies don't work that way. Economies don't work that way. I don't have this chart, but there's a chart that shows the yield curve inversion, where the short term, let me just say this without going into technical details. The yield curve is more inverted than it has been since 1929, prior to the Great Depression. It's that deep and it's that steep, and it's going to predict a recession. The only question is the recession going to be extremely deep and painful or not? The other part of that question possibly is, how long will it last? So there will be a recession. How long and how deep is up in the air. I'm not optimistic, but I am optimistic in terms of, if you prepare, regardless of what you do, if you prepare, you can capitalize on this, because values will come down, and we will again see once in a generational opportunities to buy whatever you're talking about buying, whether it's stocks or bonds or single family homes or commercial real estate, which is near and dear to my heart, at generational lows. It's already happening, friends, and it's going to happen in a very, very much more robust way. So regional banks are in trouble, right? There's more than 500 regional banks on the watch list for the Federal Reserve and the FDIC. That means we're concerned about their survivability. There were heavy players during the run-up over the last 3 years in commercial real estate lending, which historically kind of is a problem, right? When you look at those who are deep into commercial real estate, when the markets turn, they tend to fail, and fail far more often than, as an example, the larger banks, which have a very, very clear credit quality, credit underwriting criteria. And yeah, there's a huge disparity between Bank of America, Wells Fargo, JP Morgan Chase, and your average regional bank. It's huge. So what do banks need to do to shore up their position? And by the way, I'm going to get to the point of this conversation in a moment, which is how to transact today, how to unlock deals, and how to profit from these opportunities. Banks need to remove non-performing or sub-performing loans from their books and put more capital. As deposits flow out, they worry about their capital base. That's a problem from a variety of perspectives. As their loan quality declines, they need to remove the sub-performing or non-performing loans and add capital back onto their balance sheet. The way they do that, two means primarily: note sales and discounted payoffs. It's the latter of the two that I want you to focus on. But first, note sales are exploding. Today, Newmark, one of the largest brokerage houses in the world, released an offering of more than $33 billion in commercial loan notes. In other words, they're saying, I don't want to be the lender anymore. I'll sell you the paper and you could be the lender. That number is far greater than anything we've ever experienced in history. And it's happening today, which is really only inning 1 or 2. So we're seeing black swans all over the place, whether it's the increase in M1 or the increase in interest rates, or the decline in valuations or note sales. I mean, there's black swans everywhere. There's big fat tails that are telling about what's likely to come, because again, at least in my opinion, we're only in inning 2. A note sale or a note acquisition is a risky play. And who I'm talking to is your investors out there. It's a risky play because there's two components that you need to underwrite: the underlying real estate and the integrity of the loan documents. It requires underwriting and deep underwriting of both, and forecasting as well. Well, I will tell you that the par balance of the note is generally not relevant. When a buyer looks at a note, they don't look at the number that the borrower owns. Generally, now there's exclusions to that, like if there's a recourse component to it, meaning if they said, I will pay you back even if the value of the real estate falls, it's known as kind of as recourse. There's a lot more to that conversation. It's complicated. But if they promise to pay and say, I will personally pay you out of pocket if the value of the real estate falls and we have to sell the real estate to pay you off, I'll cover the difference. So par balance of the note is not really important, not to a very large degree. So discounted payoff solutions, it achieves a quick resolution. And resolution is the word that banks and lenders and servicers all use to talk about how you take a non-performing or subperforming loan and move it off the books. So it happens quickly. A note sale can happen very quickly. It puts new capital on the balance sheets of the lenders and servicers. Lenders, actually. It avoids foreclosure, which is generally the single worst type of bank loan resolution. In other words, if a bank is forced to foreclose on a piece of real estate, they're going to suffer far greater losses than if they sold the note or accepted a discounted payoff. It achieves a higher net present value for the lender due to a quick results. And what looks and the result is also a function of a willing buyer and a seller with the lender consent. And it avoids risking catching a falling knife in an environment or ecosystem that is a long way to go before it finds a bottom. So how and why a DPO? DPO offers a solid resolution that creates the highest NPV for a lender. And the lenders, again, control the purse strings. Therefore, they control the sales, marketing, and purchase of any piece of real estate. It unlocks deals as the lender now represents a pseudo equity position. If a lender has to take a loss, all equity is gone in a transaction. What you need to do as a service provider, like broker, borrower, owner, investor, or potential investor, is to prove up via a very strategic presentation how accepting a DPO is a far better solution than a foreclosure or a note sale or any other type of resolution that banks will pursue when the loan is in default. So things to know for context: lenders hold loans on their book at balances that can be far different than the par balance. So your statement might say you owe $1 million, but the way the bank might account for that loan is they could have written it down significantly because they're worried about taking future losses. And part of their governance, which is FDIC, Federal Reserve, OCC, a variety of entities, require banks to write down their assets that are not going to be held to maturity. And so a loan is an example of that. Non-accrual is a concept that I'm not going to go into great detail, but I will tell you, when a lender is concerned about your ability to pay back that loan in full, every interest payment that you make, they'll apply it against the principal balance. They won't tell you that, but that's what they do. They apply it against the principal balance to reduce what's known as their exposure. And then they also take loss reserves. It's another means by which they reduce their own book balances. If they're of the belief, and there's a variety of guidance that tells the banks how to deal with this stuff, but if there's a good chance, guys, they're not going to get their entire loan back, they need to take a loss or provision for a loss. And again, I won't go into great detail there, but bottom line is the bank balance versus the balance that you think you owe the bank could be greatly different. And I mean 50%. You think you owe $100 million and they've only got you on the books for $50 million or $1 million versus $500,000. Big distinction, which is one of the reasons why DPOs make sense. Um, Lenders will always calculate the net present value of future cash flows to help them define their decision-making process. And generally speaking, they'll use a foreclosure scenario. The reason why we're effective at doing this is simply because I've been a bank executive and the CEO of a special servicing group. I know how this stuff gets accounted for. I know what works. And this shit works. So calculating the net present value of future cash flows. So, as a broker, as an owner, investor, a borrower, what the bank will likely accept. You take the as-is value of the real estate. As is, not the purchase price, but as is value of the real estate. And we know through the CPPI index, which is the Commercial Property Price Index, values have fallen on average 16% when you combine all asset classes. That's office, mobile home parks, multifamily, industrial, retail, etc. Put them all together, the average decline is 16%. Some asset classes have fallen as much as 60%. I'm talking about office and maybe regional malls. Some industrial have fallen very little on a comparative basis. So you take the as-is value of the real estate, and then you deduct the carrying costs, and you deduct sales and disposition expenses, which is a broker, right? Title, escrow, etc. And then you all bring it back on a net present value basis. That is the number that you need to exceed. We have a proprietary model that we use that has been our bread and butter for quite some time. Happy to help you with the calculation. Reach out to me. My contact information, if you don't have it, will be at the end of the video. You must exceed the foreclosure net present value to even get your lender to entertain an offer. Why would a bank accept a DPO? Eliminates non-performing from their book, avoids suspense, expense, and time of a foreclosure. Always better than a foreclosure scenario. Look, foreclosure is the last thing a lender wants to do. It's the last course of action they want to take. And it stops, at least in the near term, the death spiral. What I mean by that is that as more distressed assets come into the marketplace and are for sale, either by choice or forced to sell due to a loan default, whether it's maturity or a cash flow problem, the more assets like that hit the marketplace, the further asset prices come down. And so it helps stop that death spiral. The good news is that if you're a buyer, you get to own the real estate far below the vast majority of your competitive set, particularly if those competitive sets have bought their properties in the recent years. So I'm going to give you a really, really good example, then I'll let you go. A client of mine bought a property in November of 2019, just prior to COVID, spent $27 million on it. COVID crushed operations because it was senior living. Look, it's a beautiful piece of real estate just south of where I'm at here in Southern California. Loan went into default and the borrower could not offer or would not request a capital call from the investors because they saw no upside. Values had declined and potentially permanently. And there was no equity to protect. And it was a bit of a long shot that they would ever recover any new investment, which is something that every sponsor out there, by the way, needs to be thinking about today. Capital calls should only be made in the event that you can assure your investors that any new capital investment would be recoverable in their principal and hopefully with a return on that. So it's one of those things we try and keep emotion out of the equation. So the underlying value of the real estate declined from $27 million, and maybe he overpaid, it was 29, to $12 million, and that was based upon an appraisal. The lender was a regional bank. Part of the problem was that was personal recourse. In other words, the borrower and the sponsor in this case signed a note saying that you won't lose any money if the value of the real estate falls below the note price. I will make up the difference. So the value of the real estate went from $27 to $12 million. The note balance was $18 million. So the lender was potentially going to take a $6 million hit. $6 million. So what do? We did our magic, and we're good at this stuff. I've been doing it a long time. We arranged for a third-party sale at the property appraised value. So $12 million, brought a third party in. They bought the real estate for $12 million, but we said, look, lender, we're not going to let this sale go through until we negotiate the recourse component. It was a $6 million liability. That's the difference between the note balance of 18 and the property value of 12. $6 million my borrower was going to have to write a check out of pocket. And they had the capability of doing that. And we said, no, not going to do that. We control the real estate. So we'll execute this sale, but we'll only do it if we can negotiate the recourse element of it. So prior to me being involved, the borrower had offered $2 million to settle that $6 million obligation. Because we controlled the timing of the transaction, negotiated it down to $250,000, saving them $5.75 million, simply because we know the rules of the game. Not complicated, but super important that you know. Why was that important for the lender? Because the loan was taken off its books. The loan no longer was on a non-accrual basis. They no longer had to take additional losses against it, and their balance sheet started to look a lot better. So that's the rules of the game. Would you like to know more? So we do three things, guys. We help owners, investors, and borrowers stop foreclosure and stop the idea of pursuing you individually for personal recourse. And we provide a sustainable solution that often improves the competitive position of the real estate and the ownership. In other words, we'll come up with solutions that make a whole lot of sense, not only just for you, but for the lender as well, because we know how the lender thinks. We know how they account for their loans. We also teach, train, and support real estate professionals, enabling them to literally crush it in the new paradigm. It's like every downturn, and this will be my fourth downturn, excluding COVID, which was more of a, a blip because of all that liquidity injected. So there's always, during a downturn event, certain people that absolutely freaking crush it in the marketplace. They learn early the rules of the game, they know the players, and they jump in and they absolutely crush it. That's what we do. We'll teach you how to do that. Whether you're an investor, a potential investor, a real estate professional like a broker or a mortgage broker, we'll teach you how to play the game. And it's unique. It's not going to be the same over the next few years as it's been for the last 12 years. It's just simply not. So learn the rules of the game. And then look, we invest in distressed assets. We've been doing that for a long time, my entire career. I started with a little triplex that I bought out of foreclosure here in Southern California. And I incented the lender to make me a loan so I could put 5% down on this just triplex, which was mostly vacant. And I don't know, my return was in the thousands of percents. It's one of those things I regret selling, like I regret selling most of my real estate, but that's part of the learning process, guys. So we invest, but our pencils are down now. We think there's a long way to go. We think we're in inning 1 or 2, and the downside is going to be dramatic. Here's my contact information. I encourage you, if you're even slightly interested in crushing it in the next, over the next 2 to 4 to 5 years. And by the way, that's typically the cycle between peaks and bottoms in valuations. And a lot of shit happens in this interim. Know the game and crush it. Whether you're an investor or a service provider, that's what we know. That's what we teach. And that's what we do really, really well. So that's my contact information. Use it. Reach back out to me or reach out to me. I hope you do well. I bless you. And thank you very much for spending this time with me. And we are